Well, it really depends on the market. And going back to your point about high yield, and what's amazing is within FX, at least there's still some search for yield out there. Looking for currencies with high real rates and LATAM to perform in equities. Our flows are showing good performance in inflation-related sectors, and basically sectors which actually give you some degree of inflation protection. So it's about real protection, and even in the safety context, we've had a lot of stress when people are looking for safe havens. They are seeking demand in those areas as well. So no matter what asset class, that clamour for yield, for real protection is still very much in place.
The mood music changed to an extent yesterday, and I do wonder whether we're simply just getting into correction territory was enough to shake some people off the sidelines, that you've got a price action 10% off the highs. And on the S&P 500, the Nasdaq was already there. Do you think that has created a re-entry point for some that have been looking for better prices on some of these equities?
Well, it really depends, I guess, on what happens tomorrow and whether the Fed believes that the market has done its job for them, right? So it becomes a bit of a self-fulfilling cycle. If you think that the Fed is going to believe that the market has done enough, then yes, it is going to be an entry opportunity. But I think what we've learned with the BOJ overnight, for example, is market expectations and market pricing. Those are two different things, right? So where you think the Fed is, where you think you are positioned relative to the Fed, there is a gap. And if that gap is still too wide, then perhaps the risk appetite still will suffer. But overall, if I take a medium to longer term view, we do think, alas, that the pain trade is still for further steepening, for further bear steepening, and the Treasury market is still there to inflict some pain.
Yeah, Jeff, good to see you, by the way, my friend. One of the market strategists at one of your opposition US investment banks says pretty much that the earnings outlook at the moment is divorced from the reality posed by waning consumer demand and corporate pricing power. Would you echo that, sir?
Well, it really depends on where. I would start to say that in terms of direction of travel, absolutely. So the consumer is feeling the pain. But one thing I would stress about the US, if we're talking about the US per se, the impact on household debt via servicing ratios on an absolute basis is still very limited compared to, say, in the UK and compared to other areas. And because of the fixed rate mortgage element, because of the growth element, when nominal growth is running at such high levels, and we saw that with the GDP numbers, the ability to service debt to actually withstand high interest rate is still much stronger in the US. So if I take a step back and look at asset allocation, where do I still want to be overweight? Alas, it's still going to be in the US. And if I'm still overweight dollars, and if I look at my Treasury book and I want to stay away from that, then maybe the pain trade is still going to be able to force my equity allocation higher than where it needs to be, irrespective of the earnings outlook. Globally, however, it's a different situation.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.